I think the big thing driving the rises are that interest rates are still very low. We know that investor activity is very high. We know that population growth is very strong, particularly into Sydney and Melbourne. So those factors combined are really driving prices higher. As far as whether there's an end in sight, I guess that really depends how effective the recent changes to lending policies are. I don't necessarily think that they're going to have a massive impact, but obviously we'll know a lot more in a few months' time once we've seen them fully implemented. I think it might cool investor appetite a little bit, but I mean, when you look at the returns that housing is offering, particularly in Sydney and Melbourne, not even factoring in rental returns, it's still pretty attractive for an investor. In terms of the interest only, I think that's risen substantially, but so too has the level of participation by investors in the housing market. I think by limiting that to 30% of new lending, certainly it means that fewer investors will be able to access interest-only lending. Interest-only lending obviously makes sense if you're negatively gearing, because the interest component is tax deductible, a principal component isn't. So I think what it might slowly start to do over time is discourage more people from negative gearing. In terms of the higher or the lower LVRs, again, I think a lot of people are just using the equity in their properties that they already have. So they're just going to need to use a bigger chunk of that equity. So I don't know that that's going to have too much of an impact. And in fact, it might actually make some of the lending, say between 75% and 80% LVR, a little bit more risky, because people that don't have a big enough deposit go to their parents or go to their grandparents and get the extra bit they need to tip into the loan, but that loan's now no longer actually mortgage insured. So that could create potentially some more risks in the market. But I don't know that the moves that we've seen to date actually go far enough and will really have much of a cooling impact on the market. It might slow growth, but it's certainly not going to stop growth dead in its track and really slow down the Sydney and Melbourne housing markets. Well, the big challenge in WA at the moment is a lot of people moved there during the mining boom. They now don't have those jobs and they're leaving. They're going to New South Wales and Victoria where the jobs are being created. There's still a lot of stock available for sale, so that's putting downwards pressure on prices as well. You'd have to say that, businesses, the economy in WA is not particularly strong. So what happens in periods like this is the cities where the jobs are being created are the ones acting as a magnet, attracting people to those cities, and that's Sydney and Melbourne. Unfortunately, they're already the two most expensive housing markets. So what Western Australia or what the government can do, I guess, is fairly limited outside of creating more jobs and a better economy in Western Australia, but that's obviously a lot easier said than done. I think it's pretty clear that interest rates are going to be on hold for some time, as we've seen this week. We know that ideally the Reserve Bank would probably like to lower interest rates, but they're concerned about the impact that would have on the Sydney and Melbourne housing markets. It would probably encourage even more growth, and that's obviously not what they want at this point in time. So my view is very much that they're going to be stable for some time. I guess a lot will depend on how successful the APRA and the ASIC crackdown on lending is. If that does actually start to see the Melbourne and Sydney housing markets slow, I don't personally think that that's going to be the case, but that would give them the breathing room to then cut interest rates. Because you look at the rest of the economy, and certainly there are a lot of other areas of the economy that need lower interest rates. The big challenge is, though, that housing is one that doesn't need lower interest rates in Sydney and Melbourne, and they don't want to add further fuel to the growth we're already seeing. I think Hobart and Canberra are obviously the markets where we're seeing acceleration. Both of them have seen growth of more than 10% over the last 12 months. Keep in mind that the Hobart housing market's essentially gone nowhere for about a decade. And I think that's really a story of people looking to move away from places like Melbourne in particular, maybe buying a retirement property down there. And I think also businesses becoming more flexible about working remotely. It's only an hour on a plane from Hobart to Melbourne, so it is something that could be done relatively easily if you need to work a few days a week in Melbourne. And Canberra, I think it's just a case that the economy there is improving. It's been a pretty soft market for a number of years as well now. Outside of the capital cities, I mean, we're still seeing pretty strong growth in areas like Wollongong, Lake Macquarie, Newcastle, and I think that's just the filtering out of what we're seeing in Sydney. Regional Victoria hasn't really followed the path of the strength we're seeing in Melbourne, but I think we're starting to see signs that the Geelong housing market's picking up, Surf Coast, those kind of areas. So I think there are a few up and coming areas. The other ones, of course, are the coastal lifestyle markets. We're starting to see increasing popularity there, and I think again that's a lot of people with a lot of equity in Sydney and Melbourne now looking for a holiday home or maybe to go and buy the home that they hope to retire to in the next 10 or 15 years.